Welcome back to the Williams Real Estate Channel. Today, a couple of points. Firstly, rental yield. What is the rental yield? So, the rental yield is the calculation, a percentage calculation used to derive value of an asset relative to its earnings. It can be used to work out what fair value is, if the property is undervalued or overvalued, and it can be used as a leading indicator for where future growth is on the horizon. So how to calculate the rental yield of a property is you divide the annual rent by the purchase price, then you times that number by 100 and that will give you a percentage. So if you get the weekly rent times 52 will give you the annual rent of a property. If you divide that figure by the purchase price, times that by 100 will give you the rental yield. So people ask me, why is the rental yield important? It's very important for a number of reasons. And I think the rental yield is not understood in the industry to a level that it should be, as some people seem to believe rental yield is not as important. But there's a number of reasons. First reason is when valuing property, you can value property based off comparable sales or replacement value. You can also value the property based off the earnings or using the rental yield. So when talking property, just similar to valuing shares within a business or ownership within a business, valuing a business or valuing stocks on the stock market, there's a concept called the price to earnings ratio or PE ratio. So if you're, as an example, going and buying Commonwealth Bank shares, typically fair value is 10 times earnings for banking stocks, a PE ratio of 10. When we're talking property, the fair value of a property is 20 times earnings. So if you calculate the annual rent, times that by 20, that'll give you the fair value of the property relative to the property's earnings, or a 5% rental yield. So 5% rental yield is considered fair value. So when you are buying a property with a 6, 7, 8% rental yield, you are buying that property undervalued relative to the earnings. And if you buy property that's undervalued, you'll be able to realize those future gains within the near future and get capital growth. When you go the other way and buy a property with a 4, 3, 2% rental yield, you are essentially overpaying for that property. The price is overvalued relative to the earnings. So this is a critical concept to get your head around, is making sure that the rental yield is at least 5%. We don't look at anything less than 5. Typically everything that we buy is between 6 to 8% rental yield. And obviously there's types of properties that have more growth prospects. So when I build people's portfolios, I like to balance both yields between 6 to 8%. So we may start by buying a property with a 6% yield that has good, decent equity in it, that will have growth, that will allow a refinance of that loan to draw equity to put into the next one. So more of a growth type of property. And then I also like to balance it up with a more cash flow type of deal with a stronger 7.5%, 8% rental yield to balance off the lower yielding assets in the portfolio, because ultimately you need a good combination of both growth and cash flow within a portfolio to allow you to continually move forward and build your portfolio and making sure it's self-sufficient. So we don't advise going and buying blue chip stuff with low yields, because sure, you may get growth, but then you'll get locked up pretty quick with finance from the banks, as the banks require a strong rental yield to allow you to keep borrowing more money. It's just like building a business. When building a portfolio, if you took $1 million loan out and went and started a business, construction business, IT business, a manufacturing business, as an example, and after year one, if you made a loss, a $50,000 loss on that $1 million loan starting the business, sure, you can save some tax, but if you wanted to then expand on your business and employ more people and buy more inventory and take out a lease to rent out a new warehouse or shop front to expand on your business and grow, and say if you went back to the bank to get another $1 million loan to pump into that business, the banks won't do it until you become profitable and increase the income, increase the earnings. Then you'll be able to keep borrowing more money and expanding on your business. That's the same concept when it comes to building a property portfolio. You need to make sure that it is self-sufficient, strong yields, 6 to 8% yields, so that the banks can continually lend you more money so you can keep buying more property and building your wealth. Because if you stick to just growth with low yields, you're essentially overpaying. It'll take many years for the yields to grow, with the rents to rise, and it's probably the main reason why most people get stuck at 1 or 2, is because they go hook themselves to a heavily negative geared property, or they put all their capital into one site and then they get stuck with finance. So to avoid those mistakes, make sure that you're getting a solid rental yield. So bad yield, less than 5 is bad. On the other side of the coin, you can also go too high. So as an example, if you go out to the boondocks, Broken Hill, you may be able to find a house that is got a 10, 11, 12% rental yield. But if it's in an area where it's not going to have much growth, then it's not going to serve you well, because you have next to no growth other than inflation. So it's a good balancing act. You need to make sure that you're in that sweet spot between 6 to 8%. If you're going higher, there's typically something wrong with the property, or it's in an area that doesn't have prospects for future growth, because ultimately growth in a market will compress yields towards the tail end of the boom. The yields will get down to 3, 4%. Then it'll go through a downturn, and then a market will stabilize. And then when the market starts to pick up again, rents rise first. That creates attractive yields, then prices then follow. So making sure you're getting in the right markets that have those future prospects is key. And using the rental yield can be used as a leading indicator for future growth. As an example, 3 to 4 years ago, we weren't buying in Melbourne because the yields were between 3 to 4%. Now we are sourcing deals in Melbourne with yields between 6 to 8%. 5, 6 years ago, we were buying heavily up in Brisbane and regional Queensland. Yields were between 7 to 8%. Now you're lucky to get a yield more than 5. The yields are being compressed as the prices have exploded. Yields are now 3 to 4%. So it can be used as a leading indicator to work out when the market's set to boom, when the market's set to top out, when the market's due to go through a downturn. Is all derived by earnings. And the higher the earnings are, ultimately those earnings will get capitalized into higher prices. So hopefully that makes a bit more sense around rental yield, what's good and what's bad. Ultimately, between 6 to 8% is key, but within that, if you peel back the layers, in order to build a portfolio, you need to make sure that you're balancing both higher yielding property and and lower yielding being low 6, 5.5%, 6%. We don't look at anything less than 5, otherwise the price is too high. But 6 is good if it's a solid growth asset, and balancing that with 7s and 8s will allow you to keep growing and moving forward. Next point I've had on my list to discuss today is a solicitor versus a conveyancer when doing a property transaction. Which should you use? So I've used both in property transactions, but also in commercial disputes and claims management, and going through to the legal systems through litigation and arbitration and mediation. Both serve their purpose, a solicitor or a lawyer or a conveyancer. So the difference is a conveyancer is more so the likes of a commercial manager. A contracts commercial manager role is like a conveyancer. Yes, they are experienced with the legal terms of a contract, but they're not to the level like a solicitor is. So the benefit of using a conveyancer over a solicitor is during that initial contract review, transaction support to run the reports, to get all the information like the title searches, the zoning requirements, finding out information about the strata, owners corp, such thing. These are activities well and probably bestly managed by a conveyancer, as if you run them through a solicitor, the solicitors can get bogged down in the legalities and are very black and white. They can't bend from their hard legal position. So during a initial contract review or managing a transaction, you need speed. Time kills deals, and if you fluff around splitting hairs over certain legal terms in the contract, the deal will go. So deals don't last forever, hence why it's good to use a conveyancer who can move quickly, turn a contract review around within 2 or 3 hours, and not sit on it for 3 or 4 days, because by then the deal's gone. So you need to move quick if you're wanting to get good deals. So that's when I like to use a conveyancer initially. And if it all runs smoothly, happy days. Ultimately, managing a transaction is a commercial management type of role. You don't necessarily want to lead with a hard legal line, like from a solicitor's point of view, because that can almost work against you. If you're too hard and you can't negotiate from a certain point or a clause in a contract, then you may more than likely just lose the deal, and then you've got nothing. So it's good to understand, okay, what are the risks, but then manage the risk and mitigate the risk and have measures in play to protect the downside, but ultimately the end goal is to get the deal over the line. So conveyances are good during the transaction. If the transaction starts to go into a dispute for whatever reason, that's when it's good to have a solicitor in your corner as well, to then come and give another higher layer of support from more of a legal point of view. So having a solicitor is good. I've got both conveyancers and solicitors, and if you need help getting connected with conveyancers and solicitors, I can guide you through that process. If you wish to use our services, I'll connect you with everyone you need to use during a property transaction. So we've got both conveyancers and solicitors that we use, but I don't lead with the solicitor. I will only rely on the solicitor if shit starts to hit the fan and it goes above the head of my conveyancer, and if I can't manage it, because I've got a commercial background in both construction and property, doing many transactions. So commercial management is key, and it's probably the most valuable part of a transaction before going legal. If you go legal, then it's up with whoever will end up once it goes to the lawyers and once it goes all legal, then the lawyers typically only win, and they run up the clock and they wish to, go back and forth to create a legal party. That's great, but no one wins in those scenarios. Ultimately, a commercial outcome is best, but obviously having the solicitor support in the background is key if you ever have to rely on it, and get that legal advice to ultimately close out a dispute and close the transaction. But not leading with the solicitor is what I've personally experienced in my not only property transaction career of doing hundreds of deals, but also transactions in terms of development transactions, construction transactions, signing up contractors. You want to lead with a commercial mind and then have a legal hat, if you can, a legal representative in your corner if you ever need to rely on it, but not leading with the legalities, because that can only get everyone offside and it can ultimately end up working against you. So things to think about. Both have pros and cons. Next on the list for today to talk about is we've been buying multiple units, villas, townhouses, and blocks of apartments. As of late, I see the best value currently in this type of asset class in both multifamily and individual units. 5 years ago, we were mainly focusing on houses in the regions as they were dirt cheap compared to they are today with high yields. Now they've just exploded, so I don't see value in the houses as of late in 2025. It's always a moving target. So right now we've been mainly focusing on both individual units and blocks. So people ask me, what's better? Should I buy one block of 10 or should I buy 10 scattered across different regions and markets? Both serve their purpose well in a diversified portfolio. The benefits of the individual is you diversify across multiple markets and sub-markets, so you can get into many different suburbs, hedging your bets around which suburb will come off well in terms of growth and cash flow. Also diversifying within the block. If you bought one unit in a block of 10 and the block needed a new roof replacement or underpinning works or a major plumbing upgrade, that's shared between all the owners. So the risk of that high expense is mitigated when you're buying an individual unit or villa, townhouse, apartment in a complex versus buying the whole block. Right now, also in 2025, the yields and the value is currently in individual versus the entry-level type of blocks, because a lot of demand's going there now as we're in this final land boom stage. A lot of demand is shifting into entry-level commercial as people are coming out of resi and looking to get into commercial. A lot of demand's going there. So you almost need to go above that entry level into the 2.5 to 3 mil plus mark in blocks. So blocks of 10, 8 to 10 plus to get the value in terms of buying. If you're buying a block of 10, you want to ideally get the individual cost per unit the same, if not cheaper, than buying an individual. You don't want to pay a premium for a whole block because essentially you're overpaying for the deal. So both have pros and cons. Obviously buying in the block, you get the whole site, you get the full control of the site, you got the full development upside, you get the whole land holding component, so you get solid growth in terms of the appreciation from the land. You don't have to pay owner's court fees. You have full control. You can gentrify a block, so you can buy a block that's tired and run down and even board it up with squatters living in it, kick them all out, renovate it, turn over the tenants, renovate it to make the units very nice and desirable, clean up the common areas, put in new tenants paying higher rate, attract better tenants. That will gentrify the block. So you can almost start to improve areas and suburbs if you buy the whole block, fix it up, turn over tenants, attract better tenants who pay higher rent to improve the asset. So you got more control. Obviously, the downside with the block is it's a lot more concentrated. You've got a lot more capital tied up in one site, and you need to make sure that the property you're buying, the structure on top is sound, because if it needs a major upgrade, new roof or underpinning or plumbing works, that is all on the one owner. So pros and cons. Blocks also typically you need between 40 to 50% deposit, so larger outlays, bigger deposits with them. So I say it's good to get a combination of both. Good to have individual scattered units so you can hedge against the markets, diversify within markets and sub-markets, and also within asset classes in blocks, but then also have individual blocks so you're getting a solid cash flow, you've got development upside, you've got full control of the site. But a good, well-balanced, diversified portfolio of both is key. Hopefully that gave you some good insights. Until next time, thanks for watching.